We know that there are certain other sectors that are hurting. Commercial real estate certainly is one. And we think it has a lot to sort through, but we don't think it's a systemic problem. One other thing in the employment report that was very interesting was average hourly earnings increased 0.8%. I don't remember seeing a number that high, except in the late 70s, early 80s, when inflation was in the double digits. On a year-over-year basis, the average hourly earnings are growing 5.1%. And then on top of that, we're going to have massive stimulus during the first quarter. So the first quarter, I can't tell you what it's going to be in terms of GDP. Some of this depends on stimulus, but we could be in the teens as far as GDP growth. So again, V-shaped recovery, stoked by fiscal stimulus. We know that the equity market is a leading indicator for the economy, and the equity market, as I mentioned, the cyclicals, they're picking up nicely. And so that gives us great confidence that we're still on the right track. Inflation, I'm watching this very carefully. I think the complacency today around inflation, especially because it didn't respond to all the stimulus after 08, 09, meaning inflation actually continued. We had a little bit of a burst, but then it really continued to surprise on the low side of expectations in the 1 to 1.5% range. And so I think a lot of people think inflation is dead. I remember the last time I heard that was, I was very early in my career, and it was the late 70s. And I was speaking to portfolio managers who remembered that in the late 60s, many economists declared inflation dead. And it seemed like that was right for a few years. I would say the late 60s. And then in the early 70s, and especially 73, inflation kicked up royally as OPEC cut production and oil prices quadrupled. So that was the beginning of the unhinging around the US going off the gold exchange standard. We haven't done anything like that necessarily, but I would say monetary policy does not seem to be hinged to anything. And so there are inflation risks out there with money growing at 26%. The question is, will it be saved so that velocity keeps going down and maybe it continues to move into the asset markets, which is where we're seeing the real inflation, stock prices, housing prices? Or will we evolve into a psychology, could be gradual, but it'll be gradual until it's not, a psychology where consumers and businesses see inflation and interest rates starting to creep up, and they say, why don't I do this or do that before inflation and interest rates continue to move up? If that were to happen, then I think we would have an inflation problem. And it's the same thing as saying as the velocity of money would be picking up as people try and get rid of their dollars as quickly as possible in order to buy goods and services before they go up in price and before interest rates go up in price. If it turns out the money continues to move into asset markets, then the velocity of money will continue to fall, and it will take the risk out of that 26% growth rate. So watching it carefully, stay tuned. And then in terms of market indicators, well, I've just mentioned equities, the bull market broadening out. That's a very good thing, very healthy. I've mentioned interest rates, long-term interest rates, the risk-free ones breaking out, breaking above downtrend lines, which is very interesting because they have not done that. We've been in a 40-year bull market in bonds. Buying the dip was always the thing to do. When bond prices went down or interest rates went up, You should have bought bonds. That may not be the right thing to do anymore. Not sure. A lot of it depends on what I just mentioned about money growth and inflation generally. We're seeing the yield curve steepen because, and what that means is long rates are going up, but short rates are not, because the Fed is holding them down. And so this is usually good for financial stocks, and financial stocks have had a very nice run recently. But they are misbehaving today, and I can't figure out why. I'm sure there's a reason out there. Credit spread, so that's the difference between high yield or junk bond yields and investment grade yields. Those spreads have narrowed, and except in the commercial real estate market, there does not seem to be much worry out there about any stresses and strains in the system. There was for a time in the energy space, but even energy prices have picked up. We're over $50 now. And just one thing on that I'll say is that when you see OPEC cutting back production, you see Exxon shutting down production and writing down assets, what we believe will happen is we're going to be in a period of extreme volatility in oil prices. We still think the trend is down. The peak was in 2008. We're going to continue to see lower highs, but we'll see extreme volatility. If we're in a V-shaped recovery, we will continue to have a bit of a burst in oil prices. Secularly, though, we think, thanks to electric vehicles, the trend is down, and that trend will remain in place. I think another variable we're watching very carefully here is the dollar. The dollar dropped roughly 7% last year. So we in the United States lost 7% in purchasing power relative to other currencies around the world. We also lost a bit to inflation, but inflation is low and may even be overstated because the statistics don't capture the digital economy and the deflationary impact of the digital economy that well. But if it does break down from here, the dollar, it will be a major breakdown if you just look at a long-term chart. And it will force the Fed. It's another variable that will force the Fed to reassess its position, and perhaps the Treasury. So mentioning purchasing power on the innovation front, I'll just mention, I'll focus on Bitcoin. And as you know, Bitcoin has doubled in the last month or so. And it crossed the 20,000 peak from 2007 and has gone to 40,000. Well, what was very interesting this week, Jeff DeGraff from RenMac, he is a technician who also watches economic fundamentals as well as stock fundamentals, but he knows how to read charts. And he's seen a lot of charts. And he said this Monday on his weekly summary, he said, I've never seen anything like this. He said, usually when there's a parabolic move like Bitcoin enjoyed in 2017, it usually takes a generation for that asset or that stock or what have you, commodity, to get back to that peak. And what he means by generation, he means 10 to 20 years. And the fact that here we are after 3 years, when I heard him say that, first of all, he didn't know what to do with it, but I thought, wow, I've never heard him say that. That means this has happened very rarely. And in fact, he does not recall anything else looking like this. So I found that interesting. But I think part of this, or the follow through, might have been triggered by, again, the bond yield doing what many people did not expect it to do, forcing all kinds of questions. Are we have we made mistakes in monetary and fiscal policy that we're going to pay for in the future? And how are we going to pay for that? And most of us would say one of the ways typically is inflation, inflating our way out of government debt. And as you know, our preferred way at ARC of addressing this issue is to grow our way out of problems with innovation. So we're going to keep advocating for that, and of course advocate against inflation, because it is the most regressive tax of all. I do believe that just the questions being raised by, is this money supply too much? Is the fiscal stimulus too much? Oh gosh, the Treasury bond yield has broken above this downtrend. No one expected that. What's happening? One of the questions could be, should I hedge myself against inflation? And I believe there is no better hedge against inflation than Bitcoin. And as we know, gold has been moving, although now it's lagging Bitcoin fairly dramatically. So it's probably, there's probably some share shift, but I do believe that both of them will do well over time until we find out the answer to this question. And I also am taking some confidence from the fact that we have individuals and companies calling us about Bitcoin and other cryptocurrencies, saying, should we put some of our cash into Bitcoin? These are companies, and as you know, Square has done that, as has MicroStrategy. I think we're going to hear about more companies putting this hedge on their balance sheet as well, particularly tech companies, innovative companies who understand the technology and are comfortable with it. I also think that there's been more validation in the space when it comes to the regulators. So Brian Brooks at the OCC, Office of the Comptroller of the Currency, has basically said that public blockchains can be used for the settlement of transactions, and banks can become nodes on those public blockchains. Well, that was like a bolt of lightning. I just never expected it. And I don't think anyone else did either, except perhaps for some in the crypto world who were working closely with the regulators, which it clearly has been the case. So again, big validation out there. Now, this is going to help the banks cut their costs. But we do think that stable coins, which this will promote, are simply they're a bridge to what we believe will be more of a disintermediation of banks. And we will see more almost direct to consumer and businesses from the central banking systems of the world. So that will come in time, but in the meantime, this is a very exciting development. Certainly is getting everyone to study and learn much more about cryptocurrencies, blockchains, other crypto assets. And from an innovation point of view, we think we have miles to go. This is just the beginning. And to put that in perspective, today, I believe Bitcoin's the equivalent of market cap or network value is a little over $700 billion. And many people with it having doubled from 20,000 to 40,000, those sound like huge numbers. Actually, it's only a little over 700 billion. What does that mean? Well, Tesla is over 800 billion. These are both very big ideas, some of the biggest ideas I have ever come across in my investing lifetime, which has been a long time. So I've been in the business more than 40 years. couldn't be more excited about all of the innovation taking place now. Never seen anything like it. And I really do think some wonderful days are ahead for the exponential growth trajectories that are going to deliver superior investment returns, no matter what the environment is. We will have to go through our ups and downs, and certainly with valuations where they are right now, I'm sure we're going to go through a doozy of a correction this year at some point. I don't know when, and I don't know why, but I do know it never hurts to take profits and to keep some powder dry so that you have the psychological wherewithal when the world seems to be falling apart to pick up on bargain basement prices like the ones we got during the coronavirus. So Happy New Year once again. We're looking forward to sharing more of our thoughts with you each month, first Friday, and would love to hear any of your questions or suggestions or constructive criticism. Thanks so much.